An excellent afternoon. We are going to start now the session on central banks and digital currencies. And I'd like to before kicking off, first of all clarify that this is not the session about cryptocurrencies. And I think it's quite important to make that distinction. The governor yesterday, De Gallo, already made that distinction, but I think it's quite important that here the idea is to talk about currencies that are effectively digital formats of fiat currencies. So they are not privately issued cryptocurrencies. And I think for further clarification, and the governor again, he made it yesterday, so we are talking effectively about a substitution of notes and coins for some digital, you could argue, account. And that is important because it's only a very small fraction of money we are talking about. But it is the only way for the non-bank public to have access to central bank money, which is through notes and coins. So in a society or in an economy where there are no more physical cash transactions, the public actually would not have access to central bank money. So that, I think, is an important aspect. Plans for introducing CBDC, as they are called, central bank digital currencies, are well advanced in many countries. Some projects are more famous than others. Sweden certainly is one that's been mentioned many times, but there are a lot of central banks working on similar projects. The key is, can CBDC support central bank objectives? And I think that is actually quite a tricky question. I looked into this a little bit, because I think there are two fundamental sort of issues. One, what is the role of central banks in issuing currency? And then, does the public actually really need access to central bank money? And on the first, on the role of central banks in issuing currency, it's not a trivial question, because if you look at central bank legislation, it's actually very vague about the role of central banks in issuing currency. For the Federal Reserve, it simply says the Federal Reserve is held to increase the growth of monetary aggregates. For the ECB, it simply says the ECB authorizes the issuance of currency. And even for the Riksbank, it simply says the Riksbank is responsible for the provision of notes and coins. But central bank legislations typically do not say anything about how central banks or why central banks should distribute currency in the first place. So the role of central banks in the issuance of currency, is very vague. On whether citizens should hold central bank money is almost a little bit like a philosophical question, because you could argue, well, in Sweden, where the share of currency in circulation to broad money is something like 2%, clearly it signals the public is content using bank money rather than central bank money. So does the public actually need central bank money? And I want to say at the beginning, transactions you do with your debit card, and this is again, just for clarification, transactions you do with your debit card or WeChat or Alipay or PayPal are bank transactions. They do not involve central bank money, and I think it's quite important. So when you think you do a digital transaction for payment, it's a bank transaction. Okay? All right. So maybe just a few facts. Central bank money in the hands of the public is disappearing. I think it depends on the countries. On average, the ratio of currency in circulation to broad money declined from about 21% in 2001 to about 16% in 2016. In advanced economies, the level of currency to broad money is only 5%. In countries like Sweden, it's only 2%. It was 10% in 2001. So you see a very rapid decline there. And there seems to be a negative correlation between the level of income per capita and the use of currency. All right. We have a super panel to discuss these issues. And I think we just go, hang on, I have to look at the order. We start with, we're going to start with Michael Bordo, one of the most prominent economic historians in the world. Jean-Pierre Landau, former deputy governor of the Banque de France, who is now, I understand, working on a project on cryptocurrency. We have Daniel Heller, who is with the UCL. the Blockchain Technology Center, which I think is a fancy name, and we at the LSE, we should think about something like that. That sounds very good. Professor Berentsen is with the University of Basel and is looking into monetary research there. And Aleksi Grym is with the Bank of Finland and is looking at digitalization there. So we have a super spectrum between academics and practitioners. Let's start with Michael. Every presenter has about 12 minutes. Thank you.
This is a paper with Andrew Levin, who's a professor at Dartmouth College, and he's a former Federal Reserve Board official. So you might wonder why an economic historian is getting involved in this. And the reason is because I'm coming at it from the history of money, and I see some great parallels between the introduction of a fiduciary currency in the 19th century in various countries, and the sort of process by which fiduciary, and that could be another word for paper, succeeded specie, gold and silver coins, and the process by which its issue shifted from the private sector towards the central banks. And I've written a paper on the Swiss National Bank and how it evolved, but I also, I've worked on, and many of my colleagues have worked on free banking in different countries. So that's where I'm coming from. There's a paper here, an NBR working paper. It's gotten a lot of attention. My colleague, Andrew, has gotten hundreds of thousands of frequent flyer miles presenting this all over the world. I've done it a few times at the Banque de France and a few other places. Anyway, so, okay. So let me just start it off by just introducing some, what my colleague calls economic history. So this is a quote which comes from the Roman Empire, and basically, what it says is that it describes the three basic functions of money. Okay, so here's a translation. Okay, and basically he's telling us what every money and banking textbooks always tells us in the first chapter. Okay, so let's define our terms. In fact, the moderator has already said that, but in a sense, digital currency is an asset in an electronic form which has functions similar to paper money. And virtual currencies is a term, or cryptocurrencies. They're digital currencies established by private entities, Bitcoin, Ethereum, and Ripple. They are not what we are talking about. Okay, because in that case, their real values can fluctuate sharply due to changes in relative supply and demand. Verification can be costly and inefficient, and for example, Bitcoin mining consumes huge amounts of electricity, similar to that of a large city. So in contrast to that, digital currencies created by private entities, in contrast to digital currency, to those created, Bitcoin, cryptocurrencies, etc., the central bank can issue digital cash that has a fixed nominal value and serves as legal paper, just like paper. Okay, and what we do is our analysis draws on a long strand of literature in monetary economics about money and the origins of money and what money does. So we focus on formulating these broad design principles rather than go into the nitty-gritty details of how to do it, okay? Our paper has some of that. And what we conclude is that digital cash can enhance all aspects of the monetary system. Okay, so again, it's in the first slide, but here I'll just give you the three basic functions of money. You have an efficient medium of exchange that's useful for all economic and financial transactions. Secondly, a store of value, a secure store of value. And the thing is that the point we make in this paper, and we develop it, is that you want to follow what Milton Friedman argued way back in 1960 about how for an efficient monetary system that currency should pay an interest rate which would be equivalent to other interest rates in the system, okay? And the third thing is a stable unit of account, and that's useful for all types of transactions. So these are the three basic functions of money. So the question is, why should central banks establish digital currency? Well, the first argument is it would improve the effectiveness of the payment system for households and small businesses. Today, as was said in the introduction, access to the payment system comes through the commercial banking system. The commercial banking system earns, in the US and other countries, earns pretty substantial rents from doing this. Okay, and so that to access the system for small business, for small people, you're basically paying the banks. You're paying something, and they have a certain amount of monopoly power in extracting these rents from you. Okay, and so what we're arguing is that, in a sense, that having digital cash could greatly reduce these costs. Second is it could facilitate cross-border financial transactions, including trade and remittances. And the third is it could impede black market activity, especially tax evasion, and it would also be a way of protecting individual privacy. And it would enhance the transparency and effectiveness of the monetary policy framework. And this is the main point I want to get across in this paper, is it would make monetary policy more efficient, especially in dealing with big shocks. Okay, so how can the design of digital cash do this, fulfill these? Well, the first thing, it would be legal tender, could be used for all public and private payments transactions. Secondly, it would be part of a real-time settlement process, payments network, which would eliminate counterparty risks and minimize overhead costs. The third is, as I mentioned, it would be interest-bearing, and there'd be a minimal spread between the rates on retail digital cash accounts and bank reserves held at the central bank. Now, as the governor said last night, okay, there is already a lot of digital currency. Reserves are digital, but currency, hand-to-hand currency, is not. Okay, and the last point we want to make, and this is the controversial point, is that, in a sense, it's going to depend upon, and in some countries it's already there, is the obsolescence of paper cash. And so what we propose is that in countries that haven't moved there, that you have these graduated fees on transfers between digital cash and paper cash. One of the things we don't say in this paper, and we've always been misinterpreted as saying, we aren't saying the government or the central bank should ban paper currency, because that is a big problem if you're talking in certain countries like the United States. Okay, so then the question is, who should provide the digital currency to the public? Okay, well, what we did, the first way we looked at is we were thinking of the central bank, in a sense, opening up accounts to anybody that could get access to digital cash. That was our first thought on this. And that, in a sense, follows from some things that happened in the 19th century where central banks did offer their own accounts. But what we found, the arguments we've got against this, is the problem of what would happen to the commercial banks. Okay, especially if there was some shock and there'd be a run from the banks to the central bank. So what we're proposing now is a public-private partnership between central banks and supervised financial institutions. And if you did that, it would foster competition among providers, it would protect the privacy of individual transactions, facilitate law enforcement and tax collection, and strengthen public confidence in banks and other supervised financial firms. And this is what some of the central banks are thinking about now. So if you have a system like in Norway or Sweden where you have a few very, very good commercial banks, the people trust them, and they also have a very solid central bank, that having some arrangement whereby the commercial banks would hold reserves in digital currency with the central bank, and then allow people to open these accounts, and the accounts would bear interest, okay, that this might be a good way to sort of get this to work. So in a sense, what the provision of digital cash does is it's like a public good. There are many public goods which are not necessarily provided by the government. They're provided by in the US we have these electrical utilities, PSE&G where I live, and transportation companies. So in some sense, it would be doing this with the commercial banks. Okay, so then what about paper currency? Well, paper cash is costly. It's not as costly as gold coins were in the 19th century, but it involves resource costs. And so there's strong incentives for banks and retailers to curtail its use, and we've seen this already happening in many advanced countries. And if the acceptance by retailers reduces consumers' rationale for keeping paper cash, okay, then you're going to get this feedback loop like you'd see in Sweden, where actually paper currency disappears. And we suggest that in places where this isn't happening, you could have some kind of graduated fee system to prevent arbitrage between paper cash and digital cash. And that, which I'll describe a little bit more in a couple of minutes, that will, in a sense, eliminate the zero lower bound. This is where this tie comes in into monetary policy, because today we have a zero lower bound, which means that it's really tough to cut interest rates. Sure, some countries do, but they can't go very far, because if they go below about 1%, then people are just going to hold cash, which has a rate of return of zero. Okay, so this is why, in a sense, to get the system to really work, you really have to move away from physical currency. And we argue that it would be very helpful for vulnerable households. Okay, this is this whole story about the fact that it's not costless to access the payment system. In the US, there's probably 10% of the population, maybe more, that don't have bank accounts. Okay, they live on payday loans, they live on cash, they live on barter. This would help solve that problem. Okay, of course, they still have to identify themselves to get an account at one of these entities, which is a problem. If you're really in the illegal sector, then you will still be out. You still have to come up with a better way of doing it. Okay, so here, this is a slide. Yeah, this is a slide that we thought was pretty cool. This is the Stockholm Central Station. And you go, my colleague was there recently. The sign says no cash. Okay, but I've been to Sweden too, and I converted into cash when I got there, and I didn't spend 1 kroner of it. I had it all when I left. Okay, so this gets to my last point, which is about monetary policy. So by eliminating the zero lower bound, there's no longer a compelling rationale for targeting a positive inflation rate. You don't have this inflation buffer argument anymore. And in fact, the central bank can foster true price stability. In other words, you could have a price level target, as we talked about earlier, and the interest rate on digital cash could serve as the primary tool of monetary policy, even responding to severe adverse shocks. So you could just raise or lower the rate, okay, and deal with any adverse demand shocks without having to worry about the problems that central banks worry about today. And so that framework would let monetary policy be more systematic, transparent, and effective. So then the question is about central bank independence. It always comes up. So with the obsolescence of paper currency, the central bank will no longer generate significant amounts of seigniorage revenue, which in many countries they transfer to the government. Okay, so there is a connection there between central banks and the government. So this is reduced, and central banks would, in a sense, operate based on some very modest fees. And also, on this system, the fiscal authorities would be solely responsible for determining the maturity composition of government debt held by the public. So again, that link between central banks and the Treasury would be eliminated, reduced or eliminated. And so that the policy framework would help insulate the central bank from political interference and fiscal pressures. So then the last point on my last slide is, well, what if central banks refrain from issuing digital currency? So this is a big deal. So I've given this paper in a lot of places, and Andy and many more. So there are countries where they're really seriously considering it, especially not in North America. Actually, Canada is. The U.S. is not even on the table at the Federal Reserve. I mean, some of the reserve banks are looking at it. Okay, so what if we just, and the American view is, let's let the Swedes work it out, and then maybe we'll deal with it. Okay, but the politics there is it's so intense that they don't even want to mention it. So if they don't do it, then monetary control could be impaired if the interest rate on reserves becomes delinked from financial markets and economic activity. And in the States, there has been a problem of the interest on reserves, on connecting the interest on excess reserves to other market rates. And the Fed's come up with mechanisms to do that. So this would kind of eliminate that problem. Secondly, there's a problem that if you don't do it and the big banks take over, okay, there are these economies to scale, there's increasing returns to scale, and you'd end up with a quasi-monopolistic payment system, which again imposes costs. And the third reason is that the central bank might be unable to mitigate really severe deflationary shocks. And so you get to the same issue today of what do we do when we hit the zero lower bound and we have a severe aggregate demand shock. So this would, in a sense, this system would solve that. Okay, so the last point is, when should it be launched? Well, we argue that to do this, it should be done in a very open and deliberate process. The public should know what's going on. And what we find is that central banks can be quite inertial. But the point is, the payment system is evolving rapidly. And the private sector is coming up with lots of things. And we'll hear about that in another session about cryptocurrencies, okay? And so if the central banks don't get their act together, they're going to have a problem. And this happened in the 19th century. Okay, there's a reason why central banks, in a sense, ended up with a monopoly of currency. Okay, it's because of some of the inefficiencies that came out of the systems that existed before that. So we argue that central banks should actively engage with government officials and banks and financial firms and in considering the digital cash. The Swedish central bank is, in a sense, serving as a role model for this approach. And they're moving pretty far in this direction, and the other central banks should follow its example. So I thank you. I'm finished. Okay.
Thank you very much. And now we're moving to Aleksander.
Oops.
Yeah. All right. We do it, yeah, as the order on the program.
Okay,
Yeah.
good. I'm actually glad that Michael was first, so I don't have to talk about electronic central bank currencies, only a little bit. I want to actually have a little bit a bigger picture and also relate it to Bitcoin. It's because of Bitcoin actually the whole discussion started again. It's an old discussion. It has been around 20 years ago, 30 years ago, you know, where the central bank should actually offer accounts to their citizens. And the answer was no, because it was a bit difficult. But now in the, you know, electronic age is much more simple. So my presentation, can I have the clicker?
Oh, here.
All right, my presentation is on stupid kids, powerful central bankers, and central bank electronic money for all. That's basically Bordo's presentation. This is Carstens, Agustin Carstens, and he had an interview in a local newspaper in Switzerland, in Basel, in my hometown. And he was saying, among things, he was saying, stop trying to create money. So he is actually heading the BIS, which is the Bank for International Settlement, which consider itself to be, and is, and it's not just that they consider itself, they are the central bank of central bankers, so the members are central bankers of that bank. So here a few statements of Carstens. Those crazy kids and their bitcoins, when will they ever learn? This is not really a quote, right? This is kind of a summary of his interview. The second one is actually a quote: young people should use their money, talents, and skill for innovation, not reinventing money. And now it's getting even better. it's a fallacy to think money can be created from nothing. I mean, I have not seen one single textbook in monetary theory which makes such a statement, because today's money that governments issue is fiat, which means it's intrinsically useless. It's created out of nothing. Okay, but let's go on. I want to just show you one graph, and because of that graph, probably most people will understand actually what the intention is of having a currency which is independent of central banks. This is the Mexican peso. You might see this graph starts in 91, ends in 2017. You had to pay like 3 peso for a dollar in 91, and later at the end you had to pay about 20 peso for a dollar. By the way, the dollar, of course, lost purchasing power during that time. So I think it's fair to say that the real value of the peso lost pretty much 90% or 95%, so I didn't calculate it exactly. What is interesting about that graph, end of 80s, Agustin Carstens was actually entering the Mexican Central Bank, and throughout his life he was more or less working either for the Mexican Central Bank or then as a finance ministry for the Mexican government. So this is so much for kids not playing with money. Okay, I think one reason why Bitcoin actually is successful or can be successful is because it's a currency that can discipline central banks. And I'm not talking about the Swiss National Bank, right? I might not even talk about the Fed. I talk about really bad central banks like Venezuela. We have now issues in Turkey, big issues. They lost just 50% of the value of the currency. I talk about Argentina, also just lost, I think last week, 50%. I'm talking about these kind of situations. I also want to talk about Bitcoin and blockchain, the relation. So the government yesterday said something, basically what he said, Bitcoin is just a speculative asset, maybe we don't have to take it serious, but blockchain is good. The fact is, you cannot disconnect the two, right? It's the inventor of the Bitcoin that actually invented the blockchain. Blockchain is just a database, but it has a few particular rules that you have adhere, and they were developed in order to have, to make it possible to have a decentralized currency in the economy. So if you read the white paper that came out in 2008, you will see the intention was actually to create a censorship-resistant peer-to-peer version of electronic cash. What does censorship-resistant mean? Let me point out a few characteristics of what that means. So first of all, you don't want to have a single point of failure. It simply means you cannot take out a server or take out an organization or take out, say, a couple of people, and then the database is corrupt and say the payment system doesn't work anymore. So in fact, Bitcoin is amazing. It hasn't had a single downtime, as far as I know, in its time. And that's very different to centralized payment system like the Visa network, MasterCard networks, even the Swiss payment system. From time to time we have failure and it just doesn't work, right? And then they restart it and get it going. It also means that there is, of course, censorship resistance also means no, central entity maintains the database. And here this is not just in order to have no, point of attack. It's the problem of the guy who you delegated the record keeping, that he becomes corrupt, right? That he misuses that power. Now, how can you solve this, right? If you don't want to delegate record keeping, and Bitcoin is a virtual currency, like electronic money. So somebody needs to keep the records, right? It's a book money. It's not a physical object. So then it must be written somewhere who owns what. But if you don't want to delegate it, the only alternative is actually to say, well, everybody can use the system, and actually everybody can be update the database. Everybody can be a record keeper, and that's exactly what the Bitcoin system, defines. Is this kind of form of decentralization. There is no, delegation of power or anything. Everybody a priori can do all tasks in that network. Okay, what does it also mean? In fact, it also means user can own their data. right? In terms of Bitcoin, it means you own your Bitcoin. It's like cash. You have it in your pocket, or not really in your pocket, but you don't delegate it. It's not like the electronic payment systems that we have today, where you basically don't own the funds, because what you have done when you open an account at a bank, you basically provide a credit to that bank. And you don't own the funds, right? It's the bank who owns the funds. It also means that you can make payment without permission, and also that nobody can be excluded from using the system. And you don't have to ask for permission if you want to use, the Bitcoin payment system. And that's very different if you have electronic payment systems today. Many people have experienced this. They have just been kicked out. All American citizens have been kicked out of the Swiss banking system, for example. Okay, let's go on. Now I get more to the focus on this panel. I would really say, thanks to Bitcoin, this discussion has restarted. What is the role of money in a society? Who should issue it? Can we have a private system? Does it have to be a government and stuff like this? And also this issue, whether a government, a central bank, should issue electronic money or virtual money. And basically, there are just two proposals, right? Central bank cryptocurrency. You have probably heard, the term Fed coin. There are people talking about Swiss coin. They're talking about, I don't know, a kroner coin, because they think about Bitcoin. And then there is this proposal, central bank electronic money for all. That's actually a very simple proposal. It just means that you can open an account at the central bank, or you delegate it. You open an account, but a segregated account in the private, at the private bank. But it's basically central bank money that you hold in that account. So let me just state how I think about these things. The first thing, I don't go through this, but the only thing what is really important here to understand, if you talk about Bitcoin or cryptocurrencies, the distinction, what really defines such a currency is decentralization, right? Because there is actually electronic money. Central banks issue electronic money already today, right? So you don't need Bitcoin for this or anything like that. But maybe if I have time, I'll come back to this anyhow. Let me say a very short thing about Fed coin. Fed coin would be a central bank issuing a cryptocurrency, like Bitcoin, which is decentralized. That's just a stupid idea. Why would a central bank issue a decentralized currency where it kind of hands out the management of that database to everybody? Right? That's a defining characteristic of decentralization. Now we get to the other point, the central bank electronic money for all. As I said, this is coming back. I think it's for good reasons. I kind of like it a lot, but it's really an old discussion. It has been around a long time already, then it kind of disappeared again. And in fact, in terms of technology, you don't need Bitcoin for that. They could have done this 20 years ago, allow people to open an account at the central bank. In fact, in Switzerland, you know that because you worked for the Swiss National Bank. If you work for the Swiss National Bank, they let you open an account at the Swiss National Bank, and you can make online banking with it, and use your credit card with it, use your debit card with it. So the technology that's not rocket science, right? Just let people open an account. That's it. What are the benefits? I'm almost finished. 2 minutes, good. I have all the benefits that Michael brought up. I see them in the same way. I think it's a good idea that central bank offer these accounts. There's only one point where we disagree. It's the zero lower bound. I actually think it's good to have an outside option where you can switch if central banks get crazy, and there were discussions during the financial crisis to lower rates to -10%. There were economists that were discussing this. You can imagine -10% on your accounts, what it means. How that can stimulate the economy is a miracle to me. Anyhow, so I finish with this one. So the basic ideas that I just presented are in this paper that came out in the review of the Federal Reserve Bank of St. Louis. And you see the title, or is the case for central bank electronic money and the non-case for central bank cryptocurrencies. Okay, thanks a lot.
Thank you very much. Jean-Pierre, you have a presentation?
Thank you, Jacques.
Right.
I think, no, I don't have slides, sorry. I think Jacques made a very brilliant introduction, and just for the sake of argument, I will respectfully disagree with two of the points he made, and even more respectfully disagree with the argument of the governor of Banque de France, whom I know very well. So the 2 points I would like to disagree is first that Bitcoin and cryptocurrency has nothing to do with the topic. Let's face it, we wouldn't have this discussion if there were not cryptocurrencies. I agree fully with what Professor Berentsen said right now. And so whatever their flaws, whatever their weaknesses, which are many, I think the cryptocurrencies forces us to consider the question of the forms of money that we want in the future, as Jacques has said. So it has something to do with it. It's not a discussion which is abstracted to it. Second point, he said this is about central bank objectives. Well, no. It's about the society's objective and our relationship with money. Central banks, we have as a group, and my former colleague Paul Tucker made that very clear in a very nice book, as citizens, as collectivity, we have delegated some very specific thing to the central banks, which is to aim at price stability, and if I look at the Fed constitution, to get an elastic supply of currency. That's it. Nothing, and Jacques was very clear about that, nothing says about the form of currencies and the form of money that we are supposed to do. This is a matter for society. Do we want something easy to use or not? Do we want something anonymous? What is our privacy at stake? I think this is something which is best left to the democratical debate. Coming now to and just as a personal remark, I've always been shocked in the euro area that it was the central bank who determined what was on the banknotes. It shouldn't be, and especially in a case like this. And I think maybe some part of the skepticism of some euro citizens towards the money would disappear if they were more involved in deciding on the forms of money. Central banks are reluctant, and it's pretty clear when you see it. There was a very nice, interesting CPMI report on central bank digital currencies that had been issued like 4 months ago, and the report makes clear the 2 questions and the 2 interrogations which come out. The first one is that they would have a reputational risk. If you issue currency, which can be used by people to do what people do with cash today, a lot of people do with cash today, then and if it's an account-based currency, then you have a reputation risk. And second, which is not mentioned, it's not very explicit in the report, you have to run forever a very large balance sheet, most likely. And that may not be if it does not fully substitute to cash. So that may be a case. So I understand I think their reluctances are very noticeable and very important. What makes the discussion very complicated is that you have 3 sets of arguments which pile on one another, and in my view, the 2 first sets are not fully relevant. So let me elaborate on that. The first is about the efficiency of monetary policy, and Michael was very, very eloquent about that. If we have a digital cash in the pockets of everybody, then we can put an interest rate on it. And if we put an interest rate on it, we have a huge amount of monetary assets which did not participate to the transmission of monetary policy, and suddenly participate to the transmission of monetary policy. So the monetary policy transmission mechanism is enhanced, and especially if we have the zero lower bound, and everybody expects it to be hit many times in the future, and it's a big problem, it's a gigantic problem. If we have the zero lower bound, we can help and solve it by putting negative interest rates on that currency. That's very nice. That's very nice theoretically. It creates 2 sets of issues which, in my view, make the whole discussion a little bit irrelevant. The first one is that you're not going to tell people like you and me, oh, we have a very nice currency to offer you in substitution to cash or in substitution to digital money that Jacques is offering you or whatever. there's only one small problem. You may have to pay a tax on it, right? With a negative interest rate. That is not going to fly at all. So that is the best way to kill the whole idea and to obscure the debate, in my view. And the second is that if you create a currency which carries interest, you create a monetary asset which is very much a substitute to a bank deposit. And then if you create a substitute to bank deposit, you run to a lot of problems of financial disintermediation of banks. So this is a second debate which piles up on the first one. The first one is enhancing the monetary transmission mechanism, and the second one is disintermediating the banks and financial stability and increasing the probability of runs. If you have a currency which carries interest, it becomes a substitute to bank deposit, then it becomes a real problem. Some people would like it. You have people, you have articles written recently that say, why shouldn't we disintermediate the bank? If you are a narrow banking person, you're very happy to have the banks disintermediated. You don't want them to be given the power of creating money, and so you just want them to have all their deposits backed by government bonds. You don't mind having a currency competing with the bank. So that's another discussion. So if we pile off those two discussions, how to solve the zero lower bound, first point, how to best intermediate, and what is the role of the banks in the intermediation system, we'll never get to a solution, because these questions have been with us for a very long time, and they are not going to be solved by any kind of technical. So the third question, which in my view is the only one which really can allow us to get a grasp on the issue, is the one you ask. What are the forms of money which people are entitled or are desired to have? And then I think it goes back to two questions. You alluded to them, Jacques, I think. The first one, is it account-based or not account-based? Do we need to have an account to use money? And the big question about cash is that it's not account-based. The big advantage is cash. It's not account-based. It's peer-to-peer. Because it's peer-to-peer, it's anonymous as well. And so we don't need to have an account. If you're not banked, and you mentioned the percentage of the population which is not banked, if you are, and in some emerging countries, a larger lot of population is not, if you're not banked, cash is the only money that you have access to. So do we want a currency which is banked on account-based or non-based? The technology, and this is the big thing that the cryptocurrency allows us to understand, the technology allows us to have a digital currency which is not account-based, which is what we call token-based, if I'm correct in the terminology. So I think this is a very important point. And personally, I think if there is one day a central bank digital currency, it should not be account-based. They shouldn't have to open an account on the people. They should issue a digital currency, which is the equivalent, as everybody said, which is a digital cash. Why should they do that? I can see at least 4 reasons. The first one, there has never been before, at least in my memory, an economy which works with only private forms of currencies. Right? So there should be that should give us some historical reflection. The second thing is about actually 3 arguments. The second thing is about the legal tender. You mentioned it. What becomes of the legal tender if we don't have a public currency in the hands of the people? So the government will have to decide in which currency they want us to pay our taxes, which you mentioned as well. So the government would have to reestablish implicitly a sort of hierarchy between the different forms of private money. This is a tricky thing. The third thing I would say is that we would be in a much more, I don't have time to develop that, but we would be in a much more sort of unstable situation if we all have only private money in our hands without any possibility of redeeming it into a public money. I just take one example, which I came out reading an article, which is very interesting. Let's say I have a government bond which is maturing in 2 years. At the moment, the government bond maturing in 2 years is a claim on government-issued money. Okay? That's it. My government bond will be paid back by a government-issued money. So if I'm in a bank, it's not a problem. I still have access to bank reserves, and I can be paid back. If I'm a citizen, a pension fund, whatever, or just a private citizen, what am I going to be paid for? I have a claim on private money. That is not the same if there's no public money around. Okay? So the whole pricing of the bond is going to change. And I haven't read anyone making studies about that, but this is one of the many examples of how an economy would be different without a public money accessible to all citizens. Let me end up that. I think they should be there. I think we should have a digital cash issued by central banks available to citizens. And I think it's up to the citizens to decide on the characteristics of this digital cash. And especially one case, I think we should all be careful about, whether we want it to be and to which extent we want it to be anonymous. That gets back to the heart of our societal question. At the moment, we have access to anonymity through cash, and all the statistics about cash show that it's not used less and less, and has been shown, for day-to-day medium of exchange transaction. It's used as a store of value, and sometimes it's used for some transactions which rather not have, clearly not. Okay? So it's not an easy question. But on the other hand, do we want total transparency on every single of the payments we made on our daily lives? I think it's a big question. It has been called by Charles Goodhart in an article about, which I recommend, which Can Central Bank Survive the IT Revolution? Goes back 20 years ago. It has been called an Orwellian nightmare. It's not me, it's him. Orwellian nightmare. Do we want an Orwellian nightmare? And I would personally, as a private citizen, just note that the governments are a little bit schizophrenic on that, because they want to protect our privacy when they're facing big data companies. But when we talk about money, which is the most private thing that you can imagine, then that concern seems to come second to other very valid policy objectives. So there's a conflict of policy objective. I don't think this conflict of policy objective should be only decided by the central bank. I don't think so. I don't think either there's any kind of emergency. In the US, the reason the US is not interested by the issue is that nobody talks about the disparition of cash in the US. So as long as we have cash, this is not an issue. This is not an issue. But of course, it's our duty to think about the future, and the future might be mainly digital in terms of currency, and then of course, the balance between public and private money will come back to haunt us. Thank you.
Thank you very much. Aleksi, that's your turn.
Okay, thank you. It's a pleasure to be here. Interesting observation is that I'm probably the only central bank representative on this panel, and also Scandinavian, so I can maybe comment on some of the thoughts presented on cashless society in Sweden and elsewhere. I'm not showing any slides, so I'm presenting a few thoughts of my own and commenting on some of the ideas presented by the other panelists. So first of all, I agree that the reason we're talking about central bank digital currency, it has to do with cryptocurrency, so I'm going to talk a little bit about that. Not because that would necessarily be a solution, but I also agree that that has been a driver of the discussion. And the second driver to me has been the decline in the usage of cash. But just to get it out of the way, I want to say that cash is not disappearing anywhere, even in Sweden or Finland or Scandinavia. Yes, it's declining. Its relative importance is declining, but it's still a major payment instrument. So I think it's a bit of an exaggeration to build arguments on the assumption that cash will disappear. It will not in the foreseeable future. Worldwide, its usage is actually growing. And the other point is that if we would have some sort of replacement for cash or a digital payment instrument which would resemble cash, it does not necessarily mean that physical cash would go away. I mean, one does not imply the other. You can have both existing at the same time, and no one actually explained any reason why one would make the other one disappear. But okay, let's talk a bit about Bitcoin and cryptocurrencies, because they have been a driver in this discussion. And I think it has to do with the fact that Bitcoin has been missold to the public as a currency, as a monetary payment instrument, which it clearly isn't. And I'm going to explain that in a bit more detail. So Bitcoin is essentially two things. It's an accounting system. And as an accounting system, it has some innovative features, but nevertheless, it's still just an accounting system. And an accounting system means that you have accounts and you have balances. And then you have transactions which change those balances. So in Bitcoin, that has been done slightly differently in terms of just technical detail, how that is implemented, but the essential outcome is the same. So like for any other accounting system, the question then is, what are we keeping account of? So think of an accounting system as basically like an Excel sheet. What are we keeping account of? And that brings us to another thing that Bitcoin is. It's an asset. It wasn't an asset initially, but it became an asset. So when this Bitcoin accounting system was created, the Bitcoin accounting system was keeping account of an imaginary thing or imaginary substance. That imaginary substance people started trading on this imaginary thing, and a secondary market was created, and it got a market price. And at that point, once the market started to be quite liquid and a lot of trading took place, it turned into an actual asset, even though it's virtual. So the trading activity kind of keeps up the asset-like quality of Bitcoin. Now, money is also an asset. Currency is an asset, but not necessarily vice versa. So not every asset is money. And that's, I think, the important point with Bitcoin. Bitcoin is a kind of asset, but it actually lacks all the essential qualities of money, which are, it has unique liquidity, it has a unique safety, and money is issued by the banking system as a whole, but you could say that the central bank more or less manages that system. So the asset which is created by the central bank is money, and the central bank doesn't create any other asset. Others are free to create other types of assets. They're just not money. They're just something else, and you can trade them. You can, they have value and so on. But they're different assets. So you can trade an asset into money and vice versa, but one doesn't turn into the other. So now we think about central bank digital currency and cryptocurrencies. I don't think any central bank is going to create another asset because they already have one. They already have the national currencies of the country that they're in. In the EZP, or in the Eurozone, it's of course the euro and so on. So there's just no point in creating for the central bank to create another asset. So then the second question is, would it make sense to use any of the technology behind Bitcoin to create something like a cash, similar to cash, like a digital payment instrument similar to cash? And they're essentially using blockchain technology for a central bank digital currency. And there the key problem is that that blockchain technology doesn't really offer anything that couldn't be done more efficiently other ways. That's sort of the outcome that I think our central bank and other central banks have come to. So we've looked at blockchain technology. So either using private blockchain technology so that we would just basically use the accounting system features of blockchain. So it would essentially be a distributed network architecture versus the kinds of more straightforward, more consolidated architectures that are used today. And those are actually much, much more cost efficient. So in terms of just the computing properties, it doesn't really offer anything. And then the second question, of course, is could it be a peer-to-peer network the way Bitcoin is? And I think that was also raised here. And I think that's a very important distinction. So Bitcoin is an accounting system that's running on a peer-to-peer network, which is very, very different from an accounting system run by any designated party on their own computer systems. And I agree, it's completely strange to think about a central bank or any bank issuing an asset and putting it on a blockchain because that would practically mean the settlement and the bookkeeping of that asset would then be done by whoever is part of the network, so you would lose control of that asset. So it just wouldn't make sense. So putting all these views together, the good news is that we already have central bank digital currency in a way, and I think the governor last night was also referring to this, is that we actually already have digital payment instruments, monetary payment instruments, and they're called bank accounts. So we have a banking system, a two-tier banking system where we have commercial banks offering different types of payments accounts and current accounts. It's overseen by central banks. It has various types of user interfaces. It has various types of features which banks are adding and offering and innovating. It's based on a safe asset which the central bank issues. There are deposit security, deposit insurance schemes which extend that safety to the bank accounts issued by the commercial banks. And that system is working more or less fine. So if you want electronic money, it's already there. So it's really difficult to see what the additional value would be from cryptocurrencies or blockchain technology, or what more could actually be done in that sense. And there's, of course, regulatory initiatives which aim to increase this kind of, make this even better. And one of them is, of course, PSD2, so Payment Services Directive, which aims at adding competition. So there's definitely room for more competition in the payments landscape. And I think central banks are quite pro-competition in that sense. But banks, of course, will remain very important for a long time because they are the custodians of those bank accounts, the custodians of the assets. So even though the payment landscape might become more fragmented and there might be new types of players, the monetary assets themselves are still residing in bank accounts, and banks are the custodians of those bank accounts, and that cannot change. I mean, that's just how it works. A comment on an expression that was used several times: electronic assets, or assets in electronic forms. This might sound like nitpicking, but I don't think it's actually possible to have assets in electronic forms at all. So assets are always either physical or they're claims. And claim, of course, a claim is intangible, but it's different. It's not really electronic. What you have electronic is a record of ownership of an asset. So you can have a physical asset and you have a claim, and then what's actually digitized on a computer is a record of ownership. And that's the Excel sheet, that's the accounting system. But the asset itself is actually not digitized, and it doesn't travel on the internet. There's no such thing as Internet of Value, there's only Internet of Data. So you can send messages on the internet which instruct a custodian of an asset to transfer ownership of an asset. The blockchain is a custodian, a bank is a custodian of an asset, and so on. A CSD is a custodian of an asset. So thinking in these terms, to kind of summarize, the concept of a central bank digital currency is really problematic. It's difficult to kind of put your head around it, what's actually meant by that, because we already have bank accounts. We already have, Bitcoin will continue to exist, and whoever wants to use it for whatever purpose, they're free to do so, it's right there. But I don't see any sort of good reason to mix the two, or to have the public to have bank accounts offered by the central bank to the general public, because commercial banks are already doing that. Yeah, I think I'll close my remarks here.
Okay, thank you. And Daniel.
Thank you, it's great to be here. As Alex mentioned, I used to work for the Swiss National Bank in various capacities, and a lot of what I will be saying comes from this background. I think it's useful to go back a little bit in history, as Michael did. I want to first talk about changes in money as medium of exchange. Then I think what is important is we should think about rules, how money is supplied, how the growth of money supply is managed, and finally, who is issuing money. So let me start with the short history of money as medium of exchange. I think you're all quite familiar. We had for millennia, we had token money, we had beads, stones, we had precious metals, then we had coins. And of course, one problem was that coins were heavy, and you didn't really know whether they were pure, right? So one innovation was banknotes, where you could verify pretty quickly whether it was a true banknote, and the other one was bank accounts. So other than banks and accounts in banks. So instead of sending heavy coins around Italy, there was a centralized system to keep track of your wealth. Then, as Ousmène mentioned, about 50 years ago, digitalization started. So and this I think has two dimensions. One is we access our accounts electronically. That's the credit cards, that's the mobile phone, online banking. So we access our money electronically, but also the transfer of money is done electronically through payment systems of different types. The large ones, systemically important financial market infrastructures are probably the biggest ones. They are heavily regulated and they have to comply with international standards. In general, we see a relative decline of banknotes, not an absolute, but we see that electronic payments have become more and more important. Here, Bitcoin enters the stage about 10 years ago, which really for the first time picks up the token-based element with the digitalization. And you outlined all the relevant characteristics. Now we can make peer-to-peer payments on an electronic basis. We could never do that before. So now, money supply. If we have commodity supply is very, very sluggish, and in a way it's random. If gold is found, gold supply will go up, but not it will not double within a year. It goes up very slowly. So if we have coin minting, then it's a little bit more complex because there's an authority that decides how many coins are minted. So Michael mentioned the Friedman rule, which is one monetary rule that will keep nominal interest rates at zero. There would be deflation, real interest rates would be positive, and the opportunity costs of holding money or cash would be zero. It's a theoretical concept. It has never been implemented. Central banks could have implemented it, but it has not happened. There's another rule that is quite famous. It's a Taylor rule, which says that central banks should set the target interest rate as a weighted average of the inflation gap, whether inflation is deviating from the target, and the output gap, whether the economy is in the steady state or not. And this was also a way to take away discretion from the central bank, that it would just have a monetary policy that is mechanistic following this rule. In reality, we also have not seen the Taylor rule implemented. What we have seen is central banks having a discretionary approach to a growth of monetary, of money, in the sense that it targets inflation and then uses a bunch of indicators, the Taylor rule being one of them, to supply the money to the market. And supply can change very quickly, like even on an intraday basis. Now, if you look at Bitcoin, you probably know that money growth in Bitcoin is gradual, but slowing over the years. Every 4 years it goes down, and eventually it's not growing anymore. So that's a very mechanistic rule, if you want. With Ether, it's gradual too, but we don't really know what. There's no sunset clause in the future there. It could keep growing forever. So the future path in Ether is not known. But you see, there's a whole bunch of various approaches to how money growth can be orchestrated. Now, the issuers of money, I think that's also an important dimension. Let's start with the system we have now. Right? Central banks were established by acts of governments. They serve as bankers for the government and also have a mandate for monetary policy. There's sometimes a tension between these two roles, but monetary policy is in essence delegated to a pretty small group of technocrats, the board, that is independent and accountable. And that's important. I think the central bank has a monopoly to issue banknotes. So Alex and I, we cannot issue our own banknotes because this would be illegal. So in that sense, but central bank money can really be created out of nothing. I mean, I'm asked a lot, being Swiss, the balance sheet of the central bank went from basically 0 to 800 billion, and people ask me, can they really just print all that money? Of course, they don't print it, but they can. They can create it out of nothing. But of course, sovereign currency is not entirely a self-fulfilling expectation. Ultimately, the value of the currency is backstopped by the government who accepts banknotes or central bank money to pay for tax liabilities. And to put it in the words of Paul Krugman, I think he put it nicely, fiat currencies have underlying value because men with guns say they do. And I think that's an important distinction to cryptocurrencies. The worthless US dollar banknote has value because men with guns say it has value and you can pay the taxes with it. Central banks are not the only ones that issue money in today's world. A big role is delegated to the commercial banks who issue money in the form of loans. It's a very tight-knit system of cooperation between the government and the commercial banks. The commercial banks can issue money under strict rules. They are supervised by authorities. And there's also a deposit insurance scheme that guarantees that depositors are covered in case of a default. So this keeps this whole private money creation in a way safe. Or that's the goal, to do this safely. And also keeps the parity between central bank money and commercial bank money. With all these backstops and the regulation, this parity is given. I usually don't care whether my money is at UBS or in my pocket as a banknote. And that's exactly the goal of this system. An alternative system would be that every bank can create its own money, issue banknotes. It's typically referred to as free banking. There have been several economists who have advocated this. The idea would be that these private monies would be more successful, that this central bank issued, government-controlled money. Here again, it's a conceptual idea. It has not been implemented. I mean, one reason is it's just illegal, right? So that's why it didn't happen. But I also think there are other reasons. When this idea was popular, inflation was high, and central banks brought inflation down, so this idea kind of disappeared. If we now look at Ether or Bitcoin, we see that there's no issuer behind the cryptocurrency. It's a decentralized protocol where the miners receive money also, or tokens, out of nothing, right? So there's no balance sheet of a Bitcoin issuer because it's really created out of nothing. So now let me come to the implications after this long introduction. So I think the benchmark for cryptocurrencies to be successful would be to be at least as good as fiat currencies. They have to be able to compete along several dimensions with fiat currency. And I think if we just look at the supply, I think that's a big weakness of Ether and Bitcoin. Supply is not adequate. The supply rule is not flexible enough to be able to compete with the sovereign currency. And in that sense, to me, the discussion on whether Bitcoin will replace sovereign currencies is a short one. It's not possible because of the supply rule. What I do think, what would be a requirement for a successful cryptocurrency would be that there is a balance sheet and that there's a governance of supply that is very fast. Right now we have a couple of guys who make monetary policy. It could be conceivable that we have a democratic currency where the holders vote all the time on the supply. And they may be as good as the technocrats, as the central bank. So I think there may be successful cryptocurrencies in the future, but they would have to have a very flexible supply with a credible balance sheet. Okay, so then now in 2 minutes, should central banks issue digital currencies? I think it was already mentioned that central banks now offer electronic money to banks and they offer banknotes to the public. So the first question is, should they offer digital currencies to the banks, right? Instead of now having electronic money on a centralized ledger, should they offer central bank money to the banks on a distributed ledger with where the miners are all known and the people in the system are also known? What we see is that central banks are investigating this. There are also a lot of private sector consortia that are looking into this. I'm not close enough to really be able to tell you when there may be a case where an application of digital currency for banks. But what we do know, there's a lot of effort by central banks and also by the private sector to offer the payment system, the large value payment system, onto a distributed ledger. Then the second question is, what should there be central bank digital currency for the public? There are two options. Alex and Aleksi mentioned this. Either you do it through bank accounts, right? Everyone has an account at the central bank, like the employees do. I would say, in a way, we are already pretty close to such a system in the sense that we have like state-owned banks where we can have accounts. We have deposit insurance. If it's credible, this gives us an asset quality that is pretty similar to an account at the central bank. And then the other question would be, should the central bank offer digital tokens, again, on a distributed ledger, like the digital virtual form of banknotes? If the central bank does this, it will surely do it in a way that where everyone is known in the system and where also the miners, the validators in the distributed system are known and they have a license. It will not be an open system like Bitcoin where everyone in this room could become a miner. Thank you.
All right, thank you very much. Okay, so we have some time for Q&A. I have to say, if we were to vote about CBDC, it sounds we have 1 neutral and 3 in favor and 1 against, sadly from the Bank of Finland itself. Look, to motivate the discussion, I said this is not about cryptocurrencies, but I do fully agree that if it weren't for Bitcoin, we wouldn't have had this discussion in the first place. So that's not what I meant. What I meant is I think we should continue to distinguishing very sharply between a currency issued by a central bank and a currency issued by private entities. That was my point of departure. I'm surprised you have 2 Swiss on the panel. They haven't mentioned the sovereign money initiative, a referendum held in Switzerland on the 10th of June, which was precisely about the idea, should Swiss citizens not have access to central bank money directly in an account of the Swiss National Bank. It was defeated, but I think it still got sort of around 40% or so, which... 30, okay, well, still quite impressive. All right, so look, let's collect a few questions, and then we give it back, pass it back to the panel. Okay, where shall we start? All right, so Nouriel has the mic already, so Nouriel, please.
Yeah, so you know, commercial banks have already access to the balance sheet of the central bank, so there is a digital currency. So if you have a central bank digital currency, you make that balance sheet accessible to every individual. You don't need blockchain to do that. You can have just 1 ledger. It works with the commercial banks. Why would you have to have 1 million computers verifying those transactions? Doesn't make any sense. it's a waste of energy, and it's not even secure. And if you have only a few people doing it, it's not a distributed system. You have an oligopoly of people who have the power of verifying those transactions. Central bank is doing already a good job with the banks. Why can't they do it with just one ledger for everybody? We're just creating an additional layer of insecurity, of other concentration risk, and so on. And then the consequences are that, you know, if you add this central bank digital currency in terms of cost, efficiency, security, it dominates any potential cryptocurrency. So all of them are gone. And as was pointed out, they are not currencies. They may be assets. They are not unit of account. They are not means of payment. They are not a stable store of value. But I think the critical point about central bank digital currency is that unless you go with the idea of Mike Bordo of having a private-public partnership, you are essentially disintermediating the banking system, because why would anybody want to have a bank account? Now you think there's a run from the banks, but you know, some people believe that actually a model of narrow banking, it's actually safer, right? The narrow banking will not be with private banks, it's going to be with central bank providing the digital currency. And then you have a system of financial intermediation where you have a loanable fund system where banks have to borrow long-term savings of the private sector in order to make long-term investments. So you avoid the credit and asset bubbles, you avoid credit cycles, and we have a system of loanable funds with narrow banking. Of course, you know, the banking system is not in favor of that type of getting totally disintermediated, and transitions may be complicated, but maybe you have a safer system. But all of that has nothing to do with blockchain or cryptocurrencies.
Okay, next question. The gentleman over there.
Hi, hello. Thank you for the wonderful panel. Tone Vase from the Bitcoin crypto space. I'd like to thank Professor Berentsen for your great articles and full understanding of Bitcoin blockchain. There's a couple of things on the crypto side I will address because I'm speaking on the next panel, but my question is specific for Professor Bordo. And in your slides, there was one where you said by going to a central bank digital currency, you would eliminate, and you use that word, counterparty risk. But the central bank itself is also a counterparty risk, as we're seeing right now with the Bank of Argentina and several others in the past. And so I wanted you to address that a little bit. And also, because with the regular banks, there is FDIC insurance, and if a single bank fails, then you still have a backup system. For a central bank, there really isn't. And my other question on your slides, in one slide you said that central banks' digital currency would provide additional privacy, and the note and the bullet point right under it said that it would, you know, facilitate better tax collection and assist law enforcement with money laundering, which seems to be a complete contradiction to the bullet point right above it. So I was hoping you could clarify.
Okay, and then Piroshka had a question here.
One of my questions Nouriel already has posed, and that is the benefit of not having to provide deposit insurance for the deposits, the consumer deposits that are placed with the central bank, and that reduces moral hazard. So it's a huge benefit in my view. But the question is whether, and that's to Michael, Professor Bordo, whether one doesn't underestimate a little bit the political risks with the scheme. And then it's not the financial stability related sort of bank disintermediation. Some disruption is not a bad thing, and you address it anyway with the private-public ownership scheme. But the fact, and that was Sachetti's point recently, that if there are significant amount of deposits accumulated at the central bank, that will be a political pressure to lend it out. So we revert back to directed lending by an independent political body without accounting. So the whole issue of central bank independence and then political pressure. So that's probably it seems to me it's an important issue to consider.
Are there any other questions? Yeah, see right.
Yes, I'm Shirai. I have a question can be anybody. When we look at this central bank digital currency, a lot of experimentation taking place in Singapore, Thailand, China, England, Canada, right? And especially emerging economies. And they think that why they pay a lot of attention to central bank digital currencies because they think this can promote like fintech industries. But a lot of central bank, like Bank of Japan or maybe ECB, and maybe Finland, if I may say, more conservative. So I'd like to know your view about how this central bank digital currency, whether they can promote this fintech and innovations.
Thank you. Any other questions? Yeah, in the back, Xiaoshen.
Yeah, my name is Xiaochen, and I will chair the next session. But for this session, and I think it just reminds me of earlier conversation when I was still in China and in discussion between fintech and the banking industry. That we had a very direct conversation between the existing banking sector and also the fintech sector, and see that why the other sector exists. And the banking sector said, we are providing banking service already for a long time with track record. And so you guys shouldn't exist. Then from the fintech sector, actually, they make it very clear that, we exist because you didn't do a good job. And because you exist for so long and so many people still don't actually have access to finance. And underbanked and unbanked still exist, and even in those large, developed countries, it's still the same problem. So here, that if we see that, no matter we see commercial banks or central banks, there are existing practice, there are existing system, doesn't mean they are good. So if there are alternatives which can really just do the existing job in a better way, and if we are true believer of market mechanism, and I think central bank. It's not strange to think that if there's a better way to do the same thing to serve the same function, and then to choose a better way. One example is when you mentioned about it's the central bank already have an asset. So then why does the central bank need another asset? I think to make it simple is that if they're in the market, there's another way, and then to just have an asset, which actually can just devalue the asset the central bank already have. And then if you as one central bank doesn't choose it, and many other central banks chose it, and finally that's the asset you owned are devalued, and then are you going to just continue to just say, hold my devalued assets without choosing the other alternative or not? And so there are a lot of, we should not pretend that, our global financial system doesn't have problem. Our central bank, our commercial bank doesn't have problem, and we have problem. And then so the idea that, everything works now and doesn't mean that we shouldn't look at alternatives. Yeah, thank you.
Thank you very much. And I think it's indeed an important reminder. This discussion, if you have it in an emerging market with a very different monetary history than the one we have here in Europe, the discussion is quite different. And I think one complication of the debate is that it is being dominated by the US and by Europe, which have a very specific and fairly stable and trustworthy institutions to basically manage the monetary and financial system. But that is not the case, I would argue, in the majority of countries. So the propensity to think beyond what we have is far greater in these countries, and I'm glad this is being brought into the debate, because it is missing if we are only talking, say, between the ECB, the Fed, etc., and the non-bank public. All right, so let me pass it to the speakers. Please feel free, of course, to also ask questions and answer the questions that you've heard. Shall we start with Michael? Yeah. No.
Okay. So there are a couple of issues that came up, and I'll just mention them quickly. The first is token versus account-based central bank digital currency. And again, I think this is like a cost-benefit story. I mean, in our paper, we make an argument for account-based systems, and we come up with a cost-benefit that it would be better. But I can also be sympathetic to Jean-Pierre's comments. Interest on currency, again, this is a technical issue, and there's a lot of literature on that, how you would do it. So you'd have to have, you have an interest rate on reserves, an interest rate on currencies, and there has to be some kind of frictions in there. There has to be some kind of spread, or you will get the problem that he mentioned about perfect substitutability. So this is the kind of thing that, in a sense, I think it can be worked out, that there is some slight difference between reserves and currency, that you would be able to do this. But again, this is, again, a technical issue. Privacy versus government. Okay. So, yeah, this is an issue. It's like, if you have token-based, there are issues of fraud and other kinds of things that come up. If you have account-based, how do you get an account? Okay, so what we argue is, how do you get a bank account? You got to walk into the bank, you got to show your driver's license, et cetera, et cetera. So for the bank to give you access, I'm just talking about a central bank, just a commercial bank. Okay, so right away, they have access to your information. Okay, that also means exactly what the second thing is, which is that if you're using this account for, say, certain kinds of activities, okay, that could be, the government could find you. So this is an issue. It's an issue today with commercial banks. And so it's a cost-benefit story, again, and in a sense, we're coming down on the side of having this, and having it done through this public-private partnership in the banking system. Directed lending, yeah, in a sense, that's the point that was raised by the moderator. This idea would really only work with advanced countries that have credibility and financial development and all that stuff. Okay, it's a big problem for emerging countries, and it's a big problem, and I'll say this is controversial, for countries which don't have rule of law and private property rights, because in a sense, it's a way of, in a sense, getting control over the public. Okay, it's another way of monitoring their citizens. That is not a good idea either. And if, to the extent that it's going to be used for that, would definitely discourage the advanced countries from going in that direction. So this, again, we're really focusing on advanced countries. The Argentina problem, yeah, sure, it's the same story. You want a central bank that's credible, et cetera, and sure, you know, if it isn't, you're going to go that route. You could have that directed lending. So I think I'll stop there.
Thank you. Let me pass it to Jean-Pierre, because you wanted to ask a question as well.
Thank you. I think I agree with Michael on the cost and benefits of both situations. My only point is that it's not up to us to decide. It's not even up to the governors, I think. It's really up to I said, the society. There was a very interesting remark. My second point is that there's a very interesting remark on the interest of emerging countries' central bank for digital currency. And I think it's part because they want to support fintech, but it's also part because the form of token money, digital token money, are much more popular in emerging economies than they are in advanced economies. I mean, in China today, most of the money you use is token money. It's still account-based, but it could stop to be account-based one day, but it's token money. So in emerging economy, they don't have this legacy investments in payments infrastructure managed by bank. They're coming with new solutions. And that forces the central banks in those countries to see how they, again, it's a question of form of money. I think we really have to we really have to internalize that very much in our way of thinking. So the central bank in those countries see the form of money evolving, and they're asking themselves how they should adjust. Then I have a question to Aleksi, because Aleksi opened a very interesting discussion. He said two things which are apparently contradictory. He said, first, the crypto were not an asset, but they are becoming an asset. I'm just simplifying, because they are traded and quoted, and they are liquid. And then he said at the end of his presentation, but nothing digital can be an asset. Okay. So there seems to be, but the crypto are purely digital. Okay. So there's a contradiction there. Apparently, I think it's very important because you have two ways of deciding whether something is an asset or not. The first way is the way you said it, which is it traded? Is it liquid? Does it have a price on which we can rely upon? And the second one is to go back to, and that would be my favorite one, to go back to basic principle. An asset is something which gives you an expected return, either certain or contingent. Now, according to the first definition, the crypto are becoming an asset. According to the second definition, they are not. They are not. And I think the regulators now are really facing a very, very difficult decision whether they stick to the first definition or the second one. I think they would make a great mistake. I can elaborate on that by considering the crypto as an asset. I think the central bankers are making a great mistake by saying they are not money, they are assets. I think they are much more dangerous as assets than money. And I invite you just to think of what would happen. I'm just to caricature the discussion a little bit. At the moment, the statistics are that, they may be wrong, they are challenged, but the statistics of the FSB, around 90% of all the Bitcoins are held by about 2.5% of the addresses, right? So it's very concentrated. And the reason it's concentrated is precisely because the people who hold them cannot sell them because the market is not liquid enough. Now, let's imagine you have 20 demands of creating of exchange-traded funds pending to the SEC. Let's imagine the SEC would say yes. Fortunately, up to now, they said no. That would mean maybe $20, $30, $40 billion, which would become available to invest into those currencies. And what would happen is that the 2% people who hold them would be able to sell them to the rest of us, to the extent that our pension funds, our insurance, or whatever is invested into ETC. Is that serving a social good or not, right? Knowing that those currencies will never bring any kind of return in terms of financial asset. They may gain someday. They may gain someday a value as medium of exchange. It's not the case today. It's not the case today. They are not medium of exchange for reasons that Aleksi well developed. So if I were a regulator, fortunately I'm not, if I were still a regulator, I would say, let's see, let's wait. If they gain a value, although they have no intrinsic value, if they gain the kind of value that monetary theory gives them, that people hold them because they expect to be able to pay for them in the next period, then we will consider them as investable. But today they have not. And giving them, by a regulatory decision, an artificial character of investable is really, really, in my view, stretching the definition of a financial asset beyond what is reasonable. And in addition, of course, the day you do that, you will have derivatives, you will have indices, you will have a lot of things. So it for those of us who've gone through 2008, 2009, it would remind us a little bit of a thing, you know. Thank you.
All right. Aleksander, maybe?
Okay. Yeah. I would like to answer the questions of the first person that asked these questions. In fact, you gave actually the answer, and I completely agree with you. So I just want to repeat somehow, because I really think it's important. So you asked, when it comes to central bank digital money, why do we need a blockchain? We don't need one. You see, if you have a blockchain, but you don't decentralize it, it's just a very inefficient database. That's what it is. It makes no sense. Either you go full-blown for decentralization, then you apply the blockchain. Otherwise, it's just an inefficient means to run a database. And that's why I think we should really separate this and say, if you want to have digital money issued by the government, which people can hold and use as a payment instrument, don't use the blockchain. It just makes no sense. Centralize it. It's much more efficient. And the other thing that I maybe want to say is something about anonymity. Sometimes people say, well, it should be the government somehow, like for cash, because when we have cash, we can make anonymous payment, and somehow, and there is actually a demand for it. Many people really, like it, that they have some anonymity. But I don't think it's the task of a government to provide an anonymous currency. They did it with cash, but because they had no choice. There is no non-anonymous cash, right? It's just not possible. But now with electronic money, you can decide whether you want to make it anonymous or non-anonymous. And here I think there's no reason to make it anonymous. The government should not be in the business to provide anonymous currency or cash. I'm totally in favor of the private sector to do that. I think Bitcoin is totally fine, right? Don't outlaw Bitcoin. Don't outlaw these other cryptocurrencies. They are going to satisfy the demand for anonymity, even though Bitcoin is not perfect, right? Take Monero, it's much better. So I think really we should distinguish this and just let government introduce a way that people can hold, the legal tender in electronic form. And it doesn't have to be anonymous.
Okay, maybe just one word on, I think the distinction between central bank money for the public and for banks is very important. And I think you mentioned in your slide the single points of failure. And I think that's exactly why central banks are so interested in moving interbank payments to a distributed ledger technology, because they can address many problems of single point of failure. Like the internet is decentralized, it's not never down, right? And for large value payments, interbank, this is relevant. For consumer payments, I agree, there's no systemic risk, and centralized systems are probably more efficient. But I think central banks take this so seriously, this development to DLT, because they know how important single points of failures are. Aleksi.
Okay, a few comments. On centralization and decentralization, to me that has always been a sort of false dichotomy, actually, and not very fruitful to even sort of talk about that. I mean, if we think about the euro system, it's 19 central banks plus ECB, 3,500 commercial banks, 25 governing council members. It's not very centralized, is it? So, I mean, the whole banking system is very, very decentralized. And I think even in the euro system mandate, it uses the word decentralized. So the system is built in a very decentralized way. And it's true that single points of failure are things to avoid, and it's something that central banks are constantly looking for, and especially sitting in this financial stability department, you see risks everywhere. But I don't see blockchain and DLT providing any solution to that. I mean, there are important points, but I don't think DLT is a solution to that. About offering why doesn't the central bank just offer bank accounts to the general public? Because it would be safer. I agree from an academic point of view that it would provide for a safer monetary system, but there's the practical point of view, is that the relationship currently between a central bank and commercial banks, just on a day-to-day basis, is quite delicate. And I mean, you couldn't just go there one morning and say, oh, by the way, we're now starting to offer payment accounts to the general public and competing for deposits. I mean, you just don't do that. I mean, you manage the whole two-tier banking system in a quite delicate manner. And even though I see the argument that on paper, in theory, it would provide for a safer banking system in many respects, it's just practically really difficult to do just like that. And I also agree it has nothing to do with blockchain. I fully agree with my colleague on the left that either you do the full-blown peer-to-peer network, and that's the whole point of blockchain in that context. Anything less, and you only end up with an inefficient database structure. Let's not pretend that there aren't problems in the financial system. Absolutely, I fully agree. And every central bank has a financial stability department which is constantly looking for the next crisis. The banking system isn't perfect, but I also think Bitcoin isn't providing any additional value to that. I mean, yes, there will be financial risks and financial crises, but crypto isn't the solution. It's very simple. And then finally, I think it's very difficult for me to understand what is meant by token-based versus account-based. If you have a computer, I mean, there's no other way to build an accounting system than to have accounts with balances. There's just no other way to do that. And the only interpretation I have for token-based is that those accounts are anonymous. That you're accessing them not based on your identity, but you're accessing them based on a private key, an encryption key. I think that's the distinction. And we're just not going to do that. I mean, it's currently illegal in Europe to provide anonymous bank accounts. You can't do that. So if a central bank would provide bank accounts, just like commercial banks are providing bank accounts, they are accessed based on your identity, not on a private key. That's, I think, a very clear thing. So in that sense, there is no such thing as token-based. It may be in theory, but in practice, it would never happen. I think that's all I wanted to say.
All right. Very good. So let's conclude. I think. Okay. Yeah. Go ahead.
On this last point, it's very interesting. A cryptocurrency is token-based, no? So it doesn't work very well. I fully agree. Decentralization is, but you can transfer value without having an account. Can you? With a Bitcoin.
You have a wallet.
Well, what is it?
The wallet is something almost like an account.
You have an address. That's the
Yeah.
account.
But an account is a liability of an institution. Here we don't have the liability. It's a
It's no
liability of
liability,
no one.
that's true.
All right?
It's no liability.
So you have an electronic way of storing and transferring value with private cryptographic key without having anyone accepting it as a liability. Is that what we mean?
I would say you have a claim on the community. You have a claim on the network to those assets.
Claim, I mean, it's like gold, right?
There's
If you
no
have a
balance
piece
sheet
of
of the
gold, there's no
network.
claim of
There's no
nobody.
There's no
claim
balance
on
sheet of the
anything.
network that I know of. Can I ask an additional question?
Sure.
Okay. To Nouriel, if you.
Yeah, one part of the anonymity of crypto. Mnuchin, Secretary of the Treasury of the US, who's not a Bolshevik, said we cannot allow cryptocurrency to become the next Swiss bank account. That means that you have to be able to track who owns these assets, who has income and capital gains out of it. Otherwise, you'll have massive tax evasion. So once the authorities are going to start to really crack down on these, that are mostly non-compliant securities, the anonymity goes completely away. And there's no way any government is going to accept that there's anything anonymous. So you have to have an account with a centralized exchange. I have to know what's there. I can monitor it. I can audit you. So that's a reality. So anonymity is just bullshit. Secondly, on the anonymity of a central bank digital currency, people worry about Big Brother knowing everything about you. But today, you know, if there is a good legitimate cause for knowing what's your P&L balance sheet, like a tax audit, I can go to the commercial bank and get all the information about you. So once you have a central bank digital currency, you can have a perfect system in which is anonymous and is private, unless you have a tax audit or a money laundering, whatever not. So like any system currently, you have privacy until you don't have the right to privacy because there's a legal case for going after information about you.
Can I
You
say
can do it with
something about
cryptocurrency, you can do it with commercial banks, you can do it with the central bank digital currency. So you can maintain anonymity, privacy as much as you want, unless there is a legitimate legal reason to go and see what's that information, whether it's criminal activity, whether it's tax evasion, whether it's KYC, AML, and you name it, and so on.
Okay.
So we are already in a world in which there is no anonymity for anybody, if you have the right.
Well, you know, my statement was normative. I wish we had some more anonymity. And because the thing, I mean, the fact in history is, you know, sometimes, you know, citizens are bad, right? And they're, you know, for that reason, you want actually to, you know, get them somehow. Yeah? They don't pay taxes or whatever. But quite often in history, actually, governments are bad. You know, they misuse their power to extort, you know, money and funds from people. And I think for that reason, actually having, you know, it's a compromise. You say, if you go full-blown without anonymity, we are just subject to these bad governments forever. And that's why I think we need to have this. I think it's good to have a mix. You know, we have bank accounts, governments issues money, and that is non-anonymous. And then we have the private sector, which says such a, I say now Monero, Zcash, others that have better privacy characteristics than Bitcoin. Bitcoin is actually not very good in that respect.
Well, all those cryptocurrencies are not going to have any anonymity. It's not going to allow it.
All right.
And if a government is bad enough to want to seize your assets, it's going to debase that currency anyhow. So
it can't.
having
Bitcoin,
cash,
can't debase
having cash doesn't
Bitcoin.
give you any security because you can always debase it with inflation.
Bitcoin you can't debase. That's the big advantage of it.
I thought it was interesting to note that we're having this discussion in, as far as I remember, the country with the highest private gold ownership in the world, like per capita. I just thought that was interesting in terms of demand for assets that can, you know, help protect your financial privacy.
Here in France?
I'm talking about physical gold, yeah.
Okay. You mean?
Okay, so how are we going to do this? Mark, we have to, okay, one last word. All right.
It's the only one word. People have different preferences on anonymity. So this is not something you're going to solve on technical grounds. Okay? We can see even around this table, in this room, people have different preferences. And we again, there's the big amounts, the small amounts. We can think differently of anonymity of big amounts. This is not a technical matter, and I would not like it as a citizen to be solved by default between people discussing whether blockchain should be centralized more or less, or between people discussing whether money should be not or not. Just Dostoevsky, money is printed freedom, minted freedom.
Thank you very much. I would also like to add, I think we should, in this discussion, I think it's important, we should not be derailed by discussion on technology. This is much more profound, I think, and we are being sidetracked if we think about the details of technology. I think that's one aspect. It's also the language. I think it's quite important we agree on a language, so there is no confusion between what we talk about when we talk about currency, when we talk about money, or when we talk about some privately issued instruments. I think that's also true about the very notion of asset. I think asset, if you look at the IMF definition, it's a financial, someone assumes a financial liability when there is an asset. And many crypto, I would call them instruments, actually do not attract any liability. And I think that's an important. And then I think in our discussion, we need to take into account the perspective of different countries. Clearly, we are biased by our own monetary experience, and I think it's important we keep it open and integrate in the perspective of others. And then last, I think, and we haven't quite, I think we have to some extent answered the question here, but I find it very difficult to believe. I think Jean-Pierre, he took up on that point, the idea that the government or a central bank leaves retail transactions entirely to private entity, has no stake in the functioning of our payment system. I find that very hard to believe, and I still think that this is the best reason why central banks should very seriously consider that they have a competitive medium of exchange that is fully compatible with the digitalization of payments that is occurring. Thank you very much. The next panel is going to be on cryptos.